Wells Fargo is getting wiped out. The U.S. economy might be in trouble. Wells Fargo, one of the prominent names in the American banking sector, has found itself at the center of challenges and controversies in recent times. Renowned for its extensive network of branches and a long history in the financial industry, it has faced issues ranging from branch closures and layoffs to allegations of unauthorized account openings. These developments have raised questions about the company's stability, compliance practices, and its response to labor disputes. Examining the current state of the market, we have tried to provide valuable insights into the broader landscape of the sector and the challenges it confronts. Wells Fargo is in the process of laying off a total of 316 employees distributed across 2 different locations within Washington County. These workforce reductions are scheduled to take effect in October. The company has clarified that these layoffs stem from its regular practice of reviewing and adjusting staffing levels to stay in sync with evolving market conditions and the specific demands of its business operations. Their objective is to optimize their workforce for maximum efficiency. They emphasized its commitment to assisting affected workers during this transition. In cases where retaining staff within the organization is not feasible, they are offering support through severance packages and career counseling. This approach underscores their dedication to treating their employees with fairness and consideration, even in challenging circumstances. The fact that several companies have closed their doors during the current year underscores the broader challenges facing the banking sector. These challenges can range from monetary downturns and market fluctuations to regulatory changes and shifts in consumer behavior. Even large and established companies like Wells Fargo may find themselves navigating these turbulent waters. One significant factor contributing to the industry's challenges is the implementation of Basel III rules. These regulations are designed to enhance the stability of institutions by imposing limits on risky financial activities that can be undertaken. While these rules are crucial for safeguarding the monetary system from excessive risk-taking, they can impact profitability and overall stability. Compliance with regulations often requires companies to hold more capital as a buffer against potential losses. This can reduce the amount of capital available for investment and lending, potentially affecting the ability to generate revenue. Additionally, the rules may limit certain high-risk activities that were previously profitable for banks, further influencing their financial performance. For them and other companies, managing the balance between profitability and regulatory compliance is a critical task. While adhering to Basel III and similar regulations helps ensure the long-term stability of the fiscal system, it may require adjustments in business strategies and operations to maintain competitiveness and profitability. Some of the layoffs are linked to employees who were attempting to unionize. In other words, some workers were seeking to form a union within the bank, presumably to negotiate better wages, benefits, and working conditions. Notably, the company's response to these unionization efforts has been to lay off workers who were involved in such activities. This action suggests that they are taking measures to prevent or disrupt unionization among its workforce. These layoffs may raise questions about labor rights and employee treatment. Unionization is often seen as a means for staff to collectively bargain for improved working conditions, and the response to these efforts by firing workers could be viewed as an attempt to suppress such rights. They are operating in a challenging environment with tight margins. This environment can lead to a focus on cost-cutting measures, which may include resisting wage increases or unionization efforts to maintain profitability. They are also involved in some of the biggest banking scandals of all time. This included the opening of many on-paper accounts. They admitted to having staff create millions of fake accounts for its customers between 2002 and 2016. Some reports indicate unauthorized accounts were being created, raising concerns about the company's practices. Jay Patterson received a statement from Wells Fargo showing a $12 balance in an everyday checking account that he had never opened. Mr. Patterson, who is a forensic accountant, immediately contacted them to close the account. The incident prompted Mr. Patterson to conduct his investigation into the matter. He discovered troubling details about how companies collect and disperse consumers' economic data, even for individuals who do not have accounts with them. This suggests that they may have obtained and used consumer information without their explicit consent. The existence of these mysterious accounts raises serious questions about the compliance and risk management within the company. Just at the end of last year, they had to go through a massive lawsuit for their wrongdoings and had to pay a huge sum to settle. They entered into a $3.7 billion agreement with regulators to settle allegations of misconduct related to auto loans, mortgages, and company accounts. The Consumer Financial Protection Bureau, CFPB, stated that the bank's actions had severe consequences for some of its customers. These consequences included wrongful car repossessions, improper actions leading to home losses, and incorrect overdraft fees on checking accounts. CFPB Director Rohit Chopra expressed concern, stating, "Wells Fargo's repeated violations of the law have negatively impacted numerous American families. The wrongdoing spans over a decade. The CFPB compelled them to refund billions of dollars to affected consumers across the country. As part of the agreement, the bank paid $2 billion to customers who suffered harm and a $1.7 billion fine. Consumers who had their cars wrongfully repossessed received a base amount of $4,000 each, with potential additional compensation based on individual circumstances." Wells Fargo CEO Charlie Scharf acknowledged the issues, saying, "We and our regulators have identified a series of unacceptable practices that we have been working systematically to change and provide customer remediation where warranted." The bank frames this settlement as a step toward reforming its troubled history. Scharf added, "This far-reaching agreement is an important milestone to our work to transform the operating practices at Wells Fargo and to put these issues behind us. The company's primary focus is on establishing a risk and control infrastructure that aligns with its size and complexity while running the company in a more controlled and disciplined manner. Over the past decade, they have faced a series of high-profile challenges, including the revelation that employees opened millions of unauthorized accounts to meet aggressive sales goals. CFPB Director Chopra viewed this enforcement action as a crucial step towards holding them accountable and promoting long-term reform for this repeat offender. Under the order, they were also made to reach out to affected customers eligible for reimbursement, addressing ongoing issues with the bank. People had varied responses to these scandals. One customer said, "Wells Fargo's financial follies continue, from unauthorized accounts to denying allegations. Now they're tossing $1 billion around like confetti, hoping to make it rain and wash away their troubles." Just last month, WF said that consumers are experiencing issues with some transactions amid a possible outage. Customers using the bank have reported difficulty using certain features of their accounts, such as being unable to use their debit card. Keeping all these in mind, the expectation of financial difficulties looming in the autumn months is a recurring theme. This anticipation is primarily driven by three key factors. There is a prevailing sense of concern about the fragility of the current climate. This unease stems from doubts about the stability of both economic institutions and the broader economy, which could potentially give rise to income-related challenges. Historical data reveals a noteworthy trend wherein significant banking crises have historically occurred during September. This historical context suggests that past events may serve as a precedent for the likelihood of income-related turmoil during this particular time of year. In light of the expected banking challenges, there is a strong emphasis on individual preparedness and a deep understanding of one's financial rights and overall monetary situation. Taking proactive measures and exercising vigilance are seen as crucial responses to the evolving uncertainties. Knowing all this, it is important to divide one's monetary assets among multiple institutions. This strategy is often referred to as diversification. It involves not keeping all your financial resources in one institution, but instead distributing them across several institutions. The rationale behind diversification is to reduce the concentration of risk. If you have all your assets, such as savings, investments, and deposits in a single company, you could be at a higher threat if that company encounters monetary difficulties or goes bankrupt. By diversifying across multiple places, you spread the risk, making it less likely that a single company's troubles will severely impact your physical well-being. The FDIC, Federal Deposit Insurance Corporation, provides insurance coverage for deposits in banks, but if the FDIC were to face fiscal challenges, it could affect its ability to insure deposits fully. Some individuals have received letters possibly indicating changes in deposit insurance or requesting customers to review their accounts. These letters may be related to the need for consumers to be aware of the status of their deposit insurance so that they know that they are not at threat of losing their life savings. Wells Fargo's recent challenges, including layoffs, compliance issues, and historical controversies, underscore the evolving landscape of the banking sector. Anticipating potential fiscal difficulties in the coming months, diversifying financial assets among multiple institutions emerges as a prudent strategy to mitigate threats and navigate the uncertainties of the economic environment.